Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. Speculation is reaching fever pitch ahead of Labour's first budget in 14 years next week, and there are suggestions that AIM shares could be in the firing line. As it happens, this week sees publication of the first of our two AIM special editions, running the rule over the market's 100 biggest companies and working out which shares have got what it takes to deliver with, or dare we say, without the tax reliefs that typically accompany them. Today, we are looking at two companies that feature in the first half of our countdown, both of which have also updated the market in recent days. That's brick supplier Brickability and AV equipment supplier Midwich. Mike Fahy is on hand to discuss the former's prospects at a time when there's speculation about bid activity in the sector too. Mark Robinson will give us his views on Midwich after that, and Alex Newman is here to share his thoughts too. To begin with, though, we are looking at construction and infrastructure services group Morgan Sindall, not an AIM 100 member, rather it's in the FTSE 250, but it did see a fairly incredible share price reaction to its trading update this week. It raised guidance. Clearly the news was good. Shares were up about 20% on the day, I think, Mark. What can you tell us about that update and what it said?
I found it hard to understand why the shares increased by that level. Well, it's probably worth mentioning that they've doubled over the last 12 months as well, so it goes into a wider trend there too. They said that the full year results are going to be significantly ahead of the previous expectations, but there wasn't a tremendous amount of detail beyond that. The star performer, I guess, was the fit-out arm, which refurbishes office space. There, the order book was up by about 15% from the 2023 year end, and it was well received by the sell side as well. We had a situation where analysts at Investec said that the consensus operating profit would increase by about 10%, with a more moderate rise of 5 to 7% in the following year. So on that basis alone, it is difficult to fathom why the shares took off in the way they did, but the shareholders themselves won't be too worried about that.
Yeah, certainly. It does seem to be the scope of that growth and the guidance which has been helpful. I was looking back as well at the interim results a couple of months ago and the earnings call there, and they were trying to play down the growth somewhat in the fit-out side of things, saying, well, this is in some ways super normal, it will normalize at some point. So maybe that conservatism has helped the shares today insofar as people were expecting some normalization, which clearly hasn't come through. This fit-out arm obviously is, I say obviously, but for those who don't know, is to do with refurbing offices and the like. Do we have much information on sort of the drivers of the growth there? What trends are behind it? I imagine we can think of a few.
Well, yeah, I mean, it fits in actually to what I've been reading in various updates from listed REITs as well. The fact that certain types of office space, high-end office space, are extreme demand at the moment because the supply isn't meeting demand in the UK overall. And it's to do with things like environmental legislation as well, making sure that offices fit in with various mandates there. But it's also to do with changing work patterns and more regionalisation measures as well. So there's a number of reasons why that end of the market has been powering along. It seems counterintuitive in some respects, but that end of the market is the demand doesn't seem to be flagging in the least. Elsewhere within the business itself, the partnership housing model is doing pretty well too, and you would imagine that's been a beneficiary of the recent political change as well, because I don't know, the general assumption, whether it's right or wrong, is that a Labour government is going to support more sort of municipal housing projects. They've stated as much explicitly. Whether it comes to pass or not, we'll have to wait, but that would benefit from that corner of the business as well.
That partnerships housing arm has a lot to do with local housing associations, local authorities, doesn't it? So too does the property services arm, but that's been struggling a little bit more. Mike, I might ask you for your thoughts briefly here, just because you did write about Morgan Sindall earlier this year.
Did.
And so probably quite pleased to see the shares rise, given you tipped them a few months ago. What do you make of the company at the moment?
I can completely understand why there has been this enthusiasm. As you mentioned, the company has been maybe trying to play down a little bit the performance of the office side of the business. This office fit out side it's really important for the company. I think it was half of last year's operating profit, and the conservatism I think comes from John Morgan, who is still running the business, who was the founder, he set up Morgan Lovell, which is part of that fit out part of the business. And I think it's kind of natural, really, for him to not want investors to get carried away and to see major share price fluctuations. But the basis, I think, for the strength in the fit out market is largely it's the fit out division's strength in London, really. You look at the Deloitte Crane surveys, and the market for new office space is now pretty much dominated by refurbs and people trying to transform older buildings. And there's been a lot of talk since the pandemic of changes in the structure of offices, and for some companies the companies at the top end wanting the most premium space, want feature space. They want areas where colleagues who maybe are not in the office every day can gather and can sit around lecture halls, and companies see this as a brand extension, so they're spending a lot more on it. And from the point of view of the contractors in this business as well, you've got the fact that its main competitor, ISG, has just gone bust, and there's kind of a real opportunity there to grab market share. When I wrote this, I got some, when I wrote the idea a couple of months ago, I got some data from Glenigan about this office fit-out market, and Morgan Sindall is the biggest player. I think he had a share of 36% when we published the idea. But ISG was the next biggest and had 33%. So it's got, ISG has a sizable chunk of this market, and it was kind of known within the industry for being quite aggressive in trying to win market share and bidding at low rates. So if it is removed from the market, then there's potential there, I think, really for potentially like an uplift in pricing as well, and for margin improvement.
Yeah, I think it would be in the frame as well, along with the likes of Kier and Costain too, because I think the outstanding order book there was about £4.5 billion. So that's a lot of sort of stalled contracts at the moment. So yeah, I mean, it represents an opportunity for them, but it also underlines the fact that one of the strengths, I think, of Morgan Sindall, that I think you appreciate this as well, is the fact that they're relatively conservative when they're involved in that tendering process as well, because that's where obviously construction companies have gone badly awry in the past as well, and so I think they put this forward as a key strength of the group, and also they tend to concentrate more on their cash as a result of this too, rather than just looking at headline margins. So I guess you could say it's a conservatively run outfit.
Yeah, definitely.
Yeah, that balance sheet strength is an attribute as well, Mark, as you mentioned the cash there, but they look in keeping with the conservatism, as you say, in other parts of the business. They look fairly resilient there. There's not really any of the concerns that dog others.
Yeah, the average daily. I don't know how they go about measuring this, but the average daily cash surplus as well was ahead of expectations too, and I guess that must be one of the metrics that industry analysts are looking at.
Yeah, certainly at times. Like now, I mean, you look at the month even prior to this update, since the ISG collapse, I think shares were up 10% on that period as well. But whether there's a direct read across, people immediately thinking what we've just been talking about, or whether it's thinking about general economic fortunes, who knows? But clearly things are going well for the company at the moment. Let's turn now, though, to our two AIM constituents who we're looking at today, starting with one that isn't a million miles away from construction. Of course, that is Brickability. It had figures out the other day itself. This is a slightly different company in terms of the share price move over the past year or so, because the brick makers and suppliers have been in the doldrums a little bit. We'll probably get on to why we think there's an opportunity there still in a minute, Mike, but let's just talk about the results themselves first of all, which don't seem too bad in the context.
No, I'll take a step back, if I will, and just talk about Brickability and where it's come from. It is, it's a business that floated on AIM 5 years ago. It's been very much in that buy and build mode. It was owned by private equity before it came onto the market, and part of the reason was to pay off some of those debts, but part of the reason was, as a lot of companies do, to use those shares as capital to buy competitors, and it's done quite a lot of that since its listing. So, I mean, if you look at its turnover when it's listed 5 years ago was 120 million, and by March, its last full year, it was up at 600 million. Now, that was down 80 million on a year earlier, and last year's numbers for March, well, you look at them and you can consider them to be quite weak, really. Sales were down 13%, but that was against a backdrop where the wider demand for bricks was down by about mid-20s anyway. I think one of the things that came through both from the half years and the full years last year is that some of these acquisitions have offered some protection by way of diversification. 2 years ago, it bought Taylor Maxwell, which is a big distributor which has a lot of timber products, decking, raw timber used in construction. So it's related, but there are other uses. It's also bought a company called, its trading name is U-Power, which makes solar roofing systems. And again, that is linked to building, but has people who may spend outside of the normal market conditions. And on the contracting arm, it spent the best part of 100 million last year buying two companies that are specialists in fire, cladding and remediation. And those businesses have traded really strongly, it said this week, for understandable reasons.
Of course. Let's talk about the sector, though, in general, the original brick sector, because I know you're quite close to it. That sounds like I don't know. That sounds like something else is going on there. But it's a sector you cover and you have done for a long time. And there's a lot of companies, listed companies in that space, so you know it quite well. Yep. What's these underlying data telling us at the moment?
As mentioned, it had been quite terrible, really. Brick makers, there are four main brick makers in the UK. Brickability is a distributor, not a maker, and it makes a fair chunk of its money from importing bricks. For years, this was a market that was considered to be kind of structurally underserved. Since the financial crisis, a lot of capacity came out of the market, and up until a couple of years ago, I think you had about 500 million bricks a year being imported, which is about 20%-ish of the total. And that was purely for the reason that brickmakers couldn't make enough. And what's happened since is that certainly the two big players in this market, which are Ibstock and Forterra, went on a bit of a capacity push. They opened new factories, they redeveloped old ones, and they spent quite a lot, possibly at the worst time, because then the market turned, and last year brick sales were down about 30%. Year to June, they'd fallen by about 9%. However, there have been signs, certainly the last couple of months, sort of brick sales have actually recovered. And when you look at like underlying numbers for construction PMI data, say, it's been really strong. It's been in positive territory for 7 months now. And I think for September, which is the last month that figures were produced, orders were at the strongest rate for about 2.5 years. So there's definitely signs of life in the sector. I think the one thing that Brickability will have to contend with is the fact that, bricks and brick distribution are still a sizable part of its business, and that with the brick makers bringing on much, increasing capacity by so much, there will be pressure on those imports. The cheapest cost are the local manufacturers, so that when the market picks up, as it's expected to, you would think that the local manufacturers are going to be the ones that benefit more than the importers.
Nonetheless, given everything you've said, really, we think there is a good argument for Brickability at this valuation.
Yeah, absolutely. Its valuation has come off quite a lot. I mentioned the size of the company now compared to when it floated. It's much more profitable than it was. Yet its share price is currently pretty much at the rate it floated 5 years ago. I had a look this morning, it was 64p, it floated at 65p. Obviously, you've had a reasonable increase in the share count as it's paid for acquisitions. The share count's up by about 40%. But when you take the forward-looking estimates for it, analysts are forecasting a 47% increase in operating profit for the current year when you take the average. And the valuation is valued at 6.5 times forecast earnings, which is below most of the other building products companies, but it's also way below the brick makers, all of which you've re-rated.
Alex, I'm going to bring you in here. Your thoughts on Brickability?
Yeah, well, I suppose I would take a slightly different view of, granted that the brick makers have re-rated quite substantially in the last year. I think I would rather own a manufacturer like a Forterra or an Ibstock than a distributor, notwithstanding the slightly awkward timing of their big capital spending in the last couple of years, but primarily because they have the capital assets. And I mean, Brickability is an interesting model because it's diversified, and in some ways it should. That should be a strength versus, kind of pure play brick makers. And the fact it is sitting across several trends. So it is, built up this import market when there was a greater reliance on imports, and now it's feeling the pain because that's retrenched. But, it's got more fingers in more pies than than I suppose the traditional, the manufacturers. To me, it just seems like it's going to be harder for them to navigate and anticipate the trends within the sector, as opposed to, the Midiwches or Forterras of this world, which, they can just benefit from, I suppose, a couple of trends. One is, the brickmaking is just an anachronism in a services-led economy. But the fact that they are they're low margin, low value, kind of belies the fact that their weight makes them prohibitively expensive to import. And I think just the long-term trend will be probably to push back against the import of bricks, when it's something that the Brickmakers Association has said, like, we can do everything that the country needs can be done domestically. If you've got a quarrying facilities to make bricks, then you should be able to make money. So it's a hard call, but I sort of I suppose here I think it's like the capital assets are the thing I would want to be invested in, as opposed to, and we'll come on to the final company we're going to talk about later, Midwich. Being a distributor is really, really hard to get right, because you're just always having to second guess and anticipate the cycle, and this is a cyclical business. So as unfashionable as kind of factories are, and UK factories especially, I would lean towards the brickmakers themselves. Just my view.
Well, there has been some speculation about M&A activity among the brickmakers themselves, in the form of Forterra approaching Midiwch a few months ago. That is now dead, it seems, but Mark Kleinman did report the other week that happened. BlackRock is building a stake in Ibstock, which seems to me to be a bit more standard. UK is going to be building more houses. We're in this for the long term, perhaps, but nonetheless, there are people getting interested in the sector. Would there be any read across for Brickability? It's a tough question, but maybe given all the different parts to its business we've been talking about, it wouldn't slot in straight away with a brick maker, and yet at the same time there is that distribution arm in there. Do we think that could be a possibility in the future, or as a deal?
In terms of the increase in interest and the re-rating, Alex is right. I think both Ibstock and Forterra are trading off such high multiples now because they're at a low point in the earning cycle, and there are huge operating leverage benefits with these businesses once demand recovers. They've got very high fixed costs in terms of energy and running the plants that make the bricks, and if they're not getting the throughput, then that really kind of affects earnings greatly. So if once those volumes start to recover, then there should be a big benefit. And I suppose one of the reasons why Middwch was in play is that it is at this low point in the cycle. I mean, Forterra haven't commented on whether or not they made this approach, but I can understand maybe why they backed away. We also featured Middwch as an idea recently, and the reason why we looked at all three of the companies when we did so, and the reason why we went for Middwch is partly valuation based, but also partly because Forterra's balance sheet looks quite stretched at the moment. Now that may well change as those operating leverage benefits come back, but it looks like it's the one that is the furthest in the trough in terms of the recovery cycle. I think one of the difficulties is among the brick makers is that it is quite a concentrated business. Ibstock's got 42% of the market. If I were to imagine Ibstock making a bid for Middwch, say, you would think that maybe they start to run up against competition concerns. And even though Forterra has a smaller share, if the market goes from 4 main players to 3, then even that may face some competition issues. With Brickability, maybe one plus point is that because it's not directly involved in manufacturing, then those competition concerns may be a little less. But I suppose the other, on the opposite side to that, is why would somebody who's in that pure play brick business want to pick up a distributor?
Yeah, well, we will see. This is very much in the realms of speculation, of course. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Let's move on to our final segment, which is on another distributor, as Alex said, Midwich, a company which has been having a fair few problems of late, certainly share price-wise, and trading update the other day, Mark, outlined a few more in terms of markets not recovering as quickly as it expected. Let's talk a little bit about that first. Midwich is the AV equipment supplier, of course.
Yeah. I mean, it was a mixed showing, really. They indicated that the top line was going to be slightly ahead of expectations, but operating profit will come in below consensus, I think. And they highlighted the fact there's some weakness in the European market, specifically in Germany and within the educational and corporate sectors there as well. They said that trading in the UK has stabilised to a certain degree, and the North American trade doesn't seem to be too bad at the moment. But they did highlight as well the troubles with profitability are linked to the inverse effects of operational gearing too, so that presents a little bit of a problem. Alex's point earlier on about distributors really does hold true with Midwich as well, because the problem that he did point out, I mean, that's been sort of magnified ever since the pandemic. And I was just taking a look at their inventory over that period there, and it's gone up by a significant degree, about 65%. I was just sort of trying to work that out in my head, but the point is, sales haven't kept pace with it as well. So, they're obviously having trouble trying to determine exactly where the market's heading for these products, which is in line with what Alex was saying earlier.
Mm. There are some other similarities with Brickability too, aren't there? In that it is quite a buy and build company. It's also been refocusing into a slightly different area. The corporate education stuff was its main bread and butter for a while, which is quite staid stuff, if you will, like projectors and displays, things like that. Now it's trying to do more on the technical side, which perhaps more what we think about when we think about AV equipment, i.e. big events, live entertainment, big light shows, that kind of thing. So it's trying, and there it does seem, as you might expect, demand is a bit stronger and there's some growth prospects. So it's trying to move in that direction, is it fair to say?
That might explain the inventory movement as well, the fairly erratic inventory movement over that period too. And they're looking at areas like internet protocol television and processing systems for imagery as well. So it's a slightly different market they're selling into at the moment, and that presents some difficulties within itself. As I say, to a certain extent, there's something of a casualty of the pandemic too, because work patterns and entertainment patterns changed rapidly in the wake of the lockdowns, and they've not exactly reverted since then, but we've got a little bit more common in 2019 than we did with 2020 as things stand at the present time. Yeah, it's a little bit of a difficult one, really, because they started when they first IPO'd as well. They did pretty well, and after the initial the slump following the onset of COVID-19, they had a bit of a purple patch. So they're not altogether dissimilar for other companies across a number of sectors. I mean, they're selling into the trade as well, and so you've got this situation where interest rates has had a negative bearing on demand for their products too, because I mean, a lot of the equipment that they sell would fall under the general category of discretionary spend. So I guess things could pick up for them slightly when corporate budgets start to increase once interest rates go down. But who knows?
They have also branched out into some unusual areas too, or not areas you'd immediately associate with an AV supplier. Fire security markets they mentioned in the trading update. Drones, I think they recently started distributing as well for various different industries, which are not really anything to do with AV either. So they're clearly trying to expand it in that regard. What do we think about the valuation? Because this is, as we say, this is a business. Profitability is quite keyed into operational gearing, and clearly a lot of the end markets are struggling. It's quite a low margin business. How do we see things at the moment? A bit of a mixed picture there as well, it's fair to say.
Yeah, they also talked about the deals that they've completed in recent time is going to boost the leverage multiple too, and they say that's well within the debt covenants, but that's a little bit of a worry at the moment if sales aren't keeping pace with inventory, as I said before. So we've taken them down to a hold recommendation. I guess we should have really done that a little bit ahead of time there too. It may be that the current rating isn't justified in that we've got a bit of potential pent-up demand in the market. And of course, as I said, in terms of their profitability, if they've got that operational gearing dynamic going, things can turn around pretty quickly.
They had the placing last year, didn't they, to fund some of these acquisitions, but haven't really moved on since then, it seems. Alex, some final thoughts maybe on Midwich?
Before we came on air, we sort of drew the parallel with Focusrite, which is, I mean, it's slightly different because they, they're serving a bit more of a retail market, and they are making, they're manufacturing some of their products. But it goes to show that, in the stock market there are lots of businesses there which have nice businesses. They're selling interesting products where, there is a demand for kind of sales companies which have technical knowledge of products from distributors around the world, which may not have a very good sort of end sales team themselves. So there's a demand for a bit more hand-holding when you're buying like a high value AUV system, for example. But what investors are often looking for in a stock is sustainable earnings growth, and not all businesses are able to achieve that Midwich has been around for, since 1979, so it's like got a very established presence in the market, though, just buying other businesses to take more market share increasingly, adding to your debt, adding to your working capital, has meant that they have had to, shift quite considerably as a business in the last 2 years. Whether that is treading water and what things look like in 5 years' time is quite hard to say. But yeah, to return to your question on the valuation, I think it's a struggle to answer that one because yes, the valuation has collapsed, but it's not quite clear at what level is the sort of the natural fair multiple for a business that is expanding its leverage, as Mark said, and kind of struggling to grow organically.
Well, these are just two of the 50 companies featured in this week's AIM 100 issue. It's the first of 2 issues. The second will be out in 2 weeks' time after the issue next week, which, of course, will focus on the budget and all the fallout from that. For now, though, we have run out of time on today's show, so we will return next week with all kinds of budget reaction, I imagine, and a bit of company news as usual as well. Thank you to Alex, to Mark, to Mike, to our producer, Maddie Apthorpe, and thank you to you for listening. We'll see you next time on another